Really talk about all of that and the market setup for the next couple of days with two special guests joining in. We've got Chakri Lokapriya of TCG AMC and Rabobank's Jane Foley is here with us as well. Both of you, thanks so much for taking time out for us. Chakri, let me begin by asking you, growing global risk aversion, another plane was shot down today, as we did tell you. Do you believe that right now it's really the geopolitical risks that have heightened, and that to a large extent is what's really got the markets in a bit of a bind?
It's unlikely to become an overhang. I think markets in the last few years from 9/11 have matured and have built in a kind of terrorist risk premium into the markets. So another unfortunate incident like the plane being shot down today, I don't think is going to impact world markets by any meaningful degree.
Right. So Chakri, in that case, what's your take on the market right now as a trader's point of view? Because we have been sliding lower on a variety of factors, just like global cues is one of the factors, GST on the other, and earnings have not been that great as well. So how do you think the next couple of days to pan out?
I think it will largely be a news flow driven market, and given that we are heading into the festive season and marriage season, you can possibly see stocks in those sectors like the Voltus and Havels of the world doing well. News driven like oil refining, E&P can probably do well, but largely it will be stock specific.
Right. A lot of emphasis, Jane, have been putting on the subsequent pace of hikes. One, of course, is the markets seem to be factoring 74% probability now that the first one would happen in December, while bond market futures suggest that will be rated only to additional 50%, 50 basis point in rest of 2016 once the first one happens in December.
I would say it's closer to the far more moderate end of forecasts. And again, this comes very much back to inflation data. Just about every measure of inflation in the US remains moderate. And of course, we must also recognize the amount of monetary tightening in the US economy through the exchange rate. And we had this described a couple of weeks ago in a fiche by Stanley Fischer. And he talked about the 15% appreciation in the real broad dollar over the last year and a half. And the impact of that on both the external sector in the US and also on inflation. So given the fact that there is speculation, there is risk that many other central banks could be easing policy further, it does suggest that the dollar will remain well supported and that will carry on doing a lot of the heavy lifting for the Fed, meaning that they won't need to do very aggressive interest rate hikes.
Chakri, the other thing that seems to be coming to the fore is now that given the volatility that we are seeing in the markets, the government might not be able to achieve its already pretty ambitious targets as well as divestment is concerned. How do you see that then impacting what the macro situation for the country is looking like?
Against the current run rate, India is probably still on target to meet the fiscal deficit of about 3.9. As of last month, it was at about 3.5%. But on the other hand, you have this one rank, one pension, and as you mentioned, divestment is clearly going to be a big shortfall. I think the initial projection was close to 70,000 crores, and now we'd be lucky if they do 40,000 crores. So they need to make up for this. I guess it's become a chicken and egg situation here, is PSU companies are waiting for better valuations to divest. On the other hand, market is waiting for them to announce some kind of divestiture so that they can participate at a later date. I think it's time PSU companies stop focusing on market valuations and focus on getting divestments out, because only after that will we see a re-rating.
Jane, let's talk about the currency markets. We've seen the dollar for one gain a fair amount of strength, but there are many who believe that this is largely being fueled due to the anticipation of a rate hike, and these up moves may not be quite sustainable once we actually see that rate hike come through. Is that an argument that you would buy?
If we look back over the last 12 months, the two best performing G10 currencies are the US dollar, followed by the UK pound. And perhaps it's no surprise that these are the only two G10 central banks that haven't used further policy accommodation this year. In fact, they're the only two central banks that have been preparing the markets for the next move in policy to be a tightening. So certainly the dollar, or the strength in the dollar, has reacted to the signals that have been provided by the Fed. But in turn, the strength of the dollar has already tightened monetary conditions, meaning that the Fed need to do less in terms of interest rate hikes.
All right, guys, Jane, Chakri, thank you so much for joining us on the show today.